What's up, it's Biggin. I'm here to show you how to use the OMM and create some trading strategies from it. So if you haven't already, go read the Using OMM slideshow and watch the Using OMM video on the RCG YouTube channel. We're going to go over some behaviors and then figure out trade ideas from there. So the first behavior in the OMM is the OMM volume divergence. This is just indicating directional bias for the session, right? So we can have some trade ideas, right? We have two main categories of counter trend and trend following. And so in this case, right, upon the break of that volume divergence here, we would, to trend follow, we would assume directional exposure, and then to play the counter trend, when we see volume convergence here, which we'll talk about in a bit, this is where you would sort of front run a counter trend right here as you sort of see the volumes collapse. So we can either capture the premium above the PML or the floor here, as well as just directional exposure via a long or a call in this case. Let's talk about volume convergence. So volume convergence is a potential counter trend trade or formation of a new trend. In this case, you can see the call side lines converging, forming bullish convergence on our put side lines here, right? And then subsequently we can see converging back to attempt formation to a bearish reversal, but you can see we fail, right? We convert our call side lines, briefly diverge bearish, then convert back to bullish, or converge back to bullish. We can see kind of the stage of events here, a formation of the initial divergence, right? And the beginnings of convergence here, and then the confirmation of convergence. Here's another big trade. Here's our PML zone or PML crossover trade. And so the PML is the peak negative exposure, and this is a very sticky area for price. And as price moves above the peak negative exposure, this shifts the chain momentum bullish, and subsequently as we move below the peak negative exposure, this shifts chain momentum bearish. And so we can see crossing over the PML here coincides with call side hedging, and then precedes this bullish divergence that occurs as we break the PML zone here. Breaking the PML zone, I like to see it form pretty strong trends towards the ceiling or the floor in whatever case, especially alongside these volume divergences here. It's pretty strong. Positive exposure results when market makers lose confidence in their original positions and must start to hedge with the flow of the market, right? And so what happens in these cases is the acceleration of a positive feedback loop. And so as we approach the inner floor, we have this what's called a cushion range. On SPX, it can range from about 8 to 11 points. On QQQ, it's about 48 to 96 cents, right? Each stock has their own individual cushion range from the ceiling or the floor. And so what we look for is, as we approach that cushion range, we want to see price bounce from there, right? Otherwise, as if it breaks through that and moves towards the actual ceiling or floor value, that's indicating that we're approaching positive exposure. So as we approach the cushion range, there's two possibilities. You have your floor, in this case, remains flat in the range and the underlying market bounces, reverts from it, does not exceed the cushion zone. Or we have positive exposure, where price breaks that cushion zone, breaks the ceiling, and then forces market makers to begin hedging with the market and form trend development. And so in these cases, we can see trend continuation for a large part of this session, and oftentimes we do not see a meaningful reversion in these cases, especially when we have OMM profiles that look like this, which I'll go into in the next slide here. But this is a very good indicator that we are not going to see any sort of meaningful reversal after a positive exposure event. All right, so here's ceiling and floor reversion. right? This happens when market makers are confident in their positioning and price fails to break their positive exposure boundaries. And so the ceiling and floor stay generally flat within their range as price engages the cushion zone. What we look for in this case, right, is the ceiling to remain flat in range as price engages it. We want to see some sort of counter trend convergence from our OMM volumes. You can see here in this case, right? We want to then see ceiling possibly come down as we start to peel away from the Cushing zone. That will help confluence us. As that OMM volume convergence forms, that will usually spark a move to target towards the PML. We don't always get there, but that is an optimal target for these kinds of plays. Otherwise, you can use your fractal to just find kind of live setups as they form and find reversion targets. But the PML reversion trade is a very common trade I see. So how do we know that we've invalidated a ceiling and floor reversion, right? Well, this happens, as we were talking about before, where the ceiling and floor begin adjusting outside of range upon contact with price because market makers are hedging. So in these cases, if we adjust the ceiling out of range, even if we don't produce a massive positive exposure move, we still have a higher potential to pin to the ceiling rather than produce reversion. And so it's really important to kind of separate circumstances that can produce reversion versus ones that are more likely to produce pin, possible small little reversion subs, but nothing significant like we look for in these example models, right? I like to look for a flat floor and flat ceiling, as in this case where it's a really tight range here. Usually upon price contact with these levels, writers are quote unquote more confident, so price is more likely to revert from those areas rather than producing a positive exposure move. So how do we determine when pin versus reversion occurs, right? As we said before, a flatter ceiling and floor is a higher confidence in the boundary. Ceiling and floor maintaining their contextual range without adjustment. This also increases the confidence of our potential reversion trend, our OMM, forming a strong counter trend convergence move instead of, we can call it going flat or chopping up, as you can see in this little square here or here or here. We also look for the ceiling and floor to not widen or compress synchronously, as widening is showing an increase in the potential session volatility, compressing is showing a decrease in the potential session volatility. And so how do we find common pin conditions, right? Well, first off, our own OMM profile is very easy to tell us. When you see your put side line here, this is puts above and puts below this red line. When you see this massive divergence form and you see all the other lines are sort of almost halfway, like 1/2 of the length of this put side line. You can see I drew these two white boxes to show that kind of measurement here. This is a pretty good indication of a pin setup, right? What we would see in this case to transition from a low probability potential for reversion to a high probability potential for reversion would be something like this, where you suddenly see a strong counter trend convergence like we were talking about earlier. We want to see that hedging also pick up, right? Same thing here for if we're transitioning from bullish to bearish, right? Same idea, right? And so common conditions where we fail to find meaningful reversion are when we lack those kind of strong counter trend formations. We go flat, right? Ceiling or floor widens, right? The directional put volume, as we're showing here, massively out of balance. It's also a bad sign for any sort of shot at reversion. And so when we fail to produce a meaningful shift in the balance, this purple arrow is kind of shifting or showing that idea. When we fail to produce that meaningful shift, we have a very low probability of producing a full transition to reversion. When we see compression in tandem where ceiling and floor sort of pinch towards the PML, it's also not a really great idea or a great potential for reversion to form. Rather, it kind of shows that volatility is compressing, right? So we have a higher probability to pin randomly between the PML zone and the ceiling, or at the ceiling or at the floor. So how do we determine congestion when balance ranges occur? Well, kind of what we were talking about in the last slide. This choppy OMM is a pretty good sign here. When you see this stuff form like a wide chop, right, where it moves back and forth pretty hard, that usually synchronizes with the formation of balance range with your spot price here. You can see the same idea, this purple box here, balance range, right? Same idea, this red box here, balance range. Same idea here, balance range at the ceiling, right? And so those OMM markers are big red flag to look for price congestion rather than trend development. The contextual PML zone, as we showed in an earlier slide, is also, it's like molasses for price. It's hard to break out of there. And so a lot of the time what we will see is range within the PML zone or continued rejection, maybe before forming a breakout. What we can also look for are what's called a tangled or indiscriminate volume, which an example would be the green and red lines in this red box here, right, where there's not really a clear divergence. Yes, we know that it's tinted bullish because of this call side line, but the lack of a clear divergence in this case usually results in the continuation of balance range, right? And kind of also what we were talking about earlier, right, where you see significant ceiling or floor compression in this case right here. This is also indicative of compressing volatility, especially to the downside. When we are already sort of pressed up into the ceiling, kind of stalling out our upside range, then you see this massive move up in the floor is just compressing the potential downside volatility to the floor zone, right, that we end up targeting. Flat options volume in this case, here it's a little distorted, but flat options volume in this case also tends to result in balance range sessions, either ranging in the PML zone or just random placement. In other cases, we can see it we can see trend develop in these flat option volume sessions, but then it just takes a very sharp V-shaped reversal, right, from that flat ceiling or flat floor like we were talking about before. All right, so now we've gone over some behaviors, right? So what kind of strategies can we take, right? We really have two types of strategy in this case. We have trend following and counter trend front running, right? So trend following is just following a breakout of any of our trend-based plays, like a PML zone breakout. In this case, we can use volume convergence, or excuse me, volume divergence. In this case, you have a lot of opportunities, right? And so in those cases, you want to assume either directional exposure or capture premium in favor of your direction, right? Same idea for the counter trend front running, where if you are betting on a potential volume convergence here, for say as we approach ceiling, what are we targeting on on a potential reversal? The fractal will give you intermediate levels between ceiling and PML. But if we are early enough in the session, this PML exists as a prime target here. And so as we approach the ceiling, on days with low implied volatility or relatively low implied volatility, finding strikes in this area for your zero DTE plays that we like to see in RCG can be very cheap and rewarding here. I've seen on FOMC days, I've seen 1 cent contracts go to over, like $1 or $2, right, in minutes. That's a lucky example, but can be profitable in this case, right? And so then balance range. How do we determine when volatility is compressing, right? This is a really key point for a lot of options traders, right? As time for most debit traders is not on your side, right? If you're trading spreads, it's a little different. But in this case, time is not on our side. And so we need to determine when is the best time to be in and out of the market. When we see formation of this large PML zone and price stay within on flat options volume, it's usually a bad sign, right? Until we form some kind of breakout and you have put side divergence, right? If we see a trend formation day and a flat options volume day, as we approach the ceiling or the floor, you could potentially capture the spread on that instance, or just take positioning for the potential V-shaped reversal, right? In another case, I see this happen a lot where price opens into its ceiling or opens into its floor, right? This actually does count as a rejection of either side. And so in this case, while we initially see our bullish hedging wound up in this case, we then see everything sort of start to stall out as we reject the ceiling and then just sort of trend towards the PMO. We can also just balance range, we can test again, right? All of these behaviors are complex. These are just individual models that all come together to create a single session of price action, right? So now that we've learned some OMM strategy, it's time to go out there and do it for yourself, find some strategies, find some more models in this case, right? This covers most of everything, but there's always new stuff to learn. So thank you very much and take care.